With more than 6,000 small and microcap companies listed, if you're looking for the next apple at the earliest stage, then Channel Check truly is the orchard. The listed companies support Channel Check, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for Channel Check so you're always up to date on what's going on at the small and microcap data place. Welcome to the Transportation and Logistics Forum, a NobleCon online investor event presented by Channel Check and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channel Check. This presentation features International Seaways, NYSE ticker symbol INSW. Following a brief overview presentation from CFO and Senior Vice President Jeffrey Pribor, Noble Research Analyst Poe Fratt will moderate a Q&A session. With that, I am pleased to present Jeffrey Pribor.
Hi, this is Jeff Pribor. I'm the CFO of International Seaways, and I'd like to thank Poe Fratt and Noble for giving me the opportunity to speak to some of you investors today and tell you a little bit about our company and the tanker market. So first, a little bit about us. We are one of the largest publicly listed tanker companies in the world, number 3 overall, number 1 of the US listed companies, or US based companies with 85 vessels. We have total liquidity of about $300 million, including an undrawn revolver of $40 million at the end of Q3. Market cap is, it varies, but it's around $800 to $900 million range. And I'm sure one of the things we can talk about with Poe later is that that's, whatever it is, it's well below its intrinsic net asset value. And finally, we'll talk about our best-in-class operations in several regards, but one that we're really proud about is our position in ESG. But let's move to the next slide. Just briefly on our history, we trace our roots all the way back to just after World War II, when our predecessor company was formed. That was Overseas Shipholding Group. But we really are a 5-year-old company. We just celebrated our 5th anniversary of having been spun off from OSG and becoming International Seaways, and have done a lot to transform the company since then. And that's what I'll talk about. Next slide. So why invest in International Seaways? If there are 3 takeaways that I'd like to accomplish getting across today, it would be first, that we're a disciplined capital allocator. From the time that we were spun off 5 years ago, we've made investments in our fleet to make it bigger and younger at the same time, including a transformational merger with another public tanker company called Diamond S, which was completed this summer. But at the same time, while high grading the fleet, we've also been able to return a significant amount of cash to shareholders, over $75 million just in the last 2 years. That's number 1. Number 2 is best-in-class practices, both in terms of our commercial operations and technical operations, and an industry leader in the tanker segment for ESG. And finally, that we are poised for an uptick in the tanker market that's coming. You've seen it in the other shipping markets. The post-COVID return of demand is going to be, we believe, bringing the tanker market significantly up in the coming quarters. And we are a safe way to play that because we're not over levered. We're very moderately levered or low levered in our industry, as you can see. But with 85 ships, we have tremendous operating leverage to when the rates do increase. You'll see that flow right to the bottom line. Next slide. I mentioned capital allocation and renewing our fleet. Here are some key points in our history since having been spun off. As you can see, the blue lines represent the tanker shipping market, and we have, as you can see from the dotted lines, made our acquisitions of vessels, whether it's in cash generally or in stock in the case of the Diamond S merger, at pretty close to the low points in the cycle, which makes a big difference when values of vessels fluctuate as much as they do. Over the long term, the return on invested capital is going to be much greater when you're able to make your investments at the bottom of the cycle, which we've done. But if you look on the right-hand side of the page, is a little snapshot of what that's accomplished since in the 5 years since we were spun off. The top right is total deadweight tons of ships has increased 70% from 5.6 to 9.5 million. Average age has declined from 12 years to under 9. Ton years remaining, this is the ton years of the fleet at times the years until they become obsolete, which is the key. It combines sort of age and size, is up 142% for, in those 5 years. So we've done a lot to renew and grow the fleet. Next slide. But at the same time, as I mentioned, we have been able to return a significant amount of capital to shareholders. So we believe a good balance of both investing in the fleet and returning cash to shareholders. For us, that really began in 2020. Prior to that, we were earlier on in our life, having been spun off, capitalized differently, and we recapitalized ourselves at the end of 2019, beginning of 2020, with bank debt that was friendly to capital allocation to shareholders. So we really date our track record on this aspect of capital allocation to the beginning of 2020. And in those last 2 years, including just Q3 of this year, so year to date, we've returned $75 million in cash to shareholders, and that's in two forms. One is a quarterly dividend of 6 cents, which we started in Q1 of 2020, share repurchase, and also special dividends, which this year, just before the merger, we provided a special dividend of about $112 million, and we had a share repurchase in 2020 and have an active share repurchase program now. Next slide. I mentioned our leading ESG footprint amongst tanker shipping companies. Of course, we are involved in fossil fuels. We know that, and that's why we're particularly laser focused on having the best possible ESG footprint we can, because it's the right thing to do, and we also think it's especially important if you're a publicly traded company involved in moving fossil fuels. I would point, there's a lot on this page. I would point you to two things in particular. One, item 1 on the bottom. We were the first tanker shipping company to have a sustainability linked loan. So we did that in January 2020, tying our interest rate in part to the performance in terms of greenhouse gas emissions of our ships, and that was a groundbreaker. And number 7 at the bottom, we've always been in the top 3 of all shipping companies, public listed companies, ranked in the ESG ranking by an independent third party that looks at about 80 or so publicly traded shipping companies, and we've, since they started those rankings, always been in the top 3. Next slide. One other aspect of our commitment to ESG is in the capital expenditures that we've undertaken. We have committed to build, or in the process of building, 3 new VLCCs, our largest category of tankers, of crude tankers, in Korea, that are dual fuel. That means they're LNG, able to be fueled by LNG as well as conventional marine diesel fuel. Why is this significant? Because LNG is really important for the energy transition. We know that it's not the long-term, that gas is not the long-term answer to zero carbon, but in the next 10 years, it's going to be a very important part of getting less emissions out of the shipping industry. And we're very proud to have partnered with Shell, who's chartered these vessels from us on a long-term 7-year charter. So we think that demonstrates our commitment to ESG. Let's next slide, please. Just so you understand about how we operate, the other aspect of us being best in class is the 2 other key components of running a shipping company are the commercial and technical or operational side of the business. Commercially, we deploy our vessels in pools. Generally speaking, they're pools that we own ourselves, such as Tankers International, the one on the left there of the top part of the page. That's the largest VLCC tanker pool in the world. owned by ourselves and one other shipping company. The benefit of being in a pool is scale. It gets us much more in front of oil companies than we would be on our own. So generally a higher utilization and brings down the best possible rates that we can by being in the best possible pools. And technically, we have a very strong background of technical management, but chose about 6 years ago to outsource technical operations, which is crewing and maintenance, et cetera, to V ships, and with the acquisition of Diamond S, a number of other world-class ship technical managers. And we find that that really provides the best practices and benchmarking that gives us the best possible, best-in-class operational side as well. Next slide. Now a little bit about our balance sheet and our financials before we turn to the market. This is our balance sheet, a snapshot of our balance sheet as of September 30th. I'd point you to the bottom left. What is really striking is how the balance sheet has grown by way of the merger with Diamond S. Diamond S was a publicly traded company based in Connecticut. We're based in New York. The two companies came together, were fairly close in size. It was a stock for stock deal. We didn't issue any cash or debt to do the transaction, just shares. But when you put together the two companies together, you can see it's a significant increase in size. If you just look at the bottom, the equity has gone up to 1.245 billion total equity of the combined company. So quite an impressive growth of the company's balance sheet this year, while still remaining low leverage. As you see on the right, our net debt to total capitalization is under 44%. And our net loan to asset value is about 45%. So well under 50 to 55%, which is sort of more commonplace in the industry. Next slide. And this is a little more about our debt, and the takeaways that I'd like you to get from this page are that we have a diversified portfolio of debt. It's really important not to depend on any one bank or set of banks or one provider of capital, and we've done that. We have everything from unsecured notes, so-called baby bonds, to 3 bank facilities that are referred to as the DSSI facilities, and the core facility, which was an International Seaways legacy facilities, in each case led by major Scandinavian European shipping banks. That, as I mentioned before, gives us low costs and the flexibility to allocate capital, including to shareholders. That's very important. And none of these are near-term maturities, so that's another key factor. And overall, it's very low cost. You see weighted average interest rate 3.31%. So we are able to keep the cost of interest really low. If you see the Ocean Yield sale, SLB is sale leaseback. It's one of our most recent transactions. That's LIBOR plus 405, but that was 90% loan to value. So on an apples to apples basis, that's very, very competitively priced compared to the other facilities, which are more like 50% loan to value. The amortization is a very healthy $46 million a quarter. So we naturally are deleveraging quarter by quarter. Next slide, please. Now I'd like to spend the next few minutes talking about the tanker market. First of all, it's our time. What this slide is showing you, the dark blue line is tankers, and you can see that over time, the various sectors of shipping don't necessarily correlate exactly, but they do generally move in patterns. But what's most important is to look on the far right and see that the other sectors of the shipping industry have had the response to COVID. I think we all know it. We hear about the lines at the ports, containers, the delays, et cetera, which have some negative aspects for consumers, but they've been really good for the container and dry bulk segments, which have really had a superior year. Well, that hasn't been the case for us yet, and I'll explain why in a minute, but it's definitely our time. Tankers are poised for the recovery in our market. So it's a really good time to be looking at this segment, we believe, for potential investment. Next slide. So there's a lot here, and I invite you to look on our website where we'll have this presentation posted. So I won't take you through every word, but just 3 takeaways from this slide. The top, near term. Why is it our time? Why is it about to be really interesting to be invested in tankers? First of all, oil demand it has recovered and continues to recover just about to pre-pandemic levels. We're just about back at that 100 million barrel a day production and consumption level for oil. Critically important, the next point, inventories are down. They're below the 5-year averages and approaching the 10-year levels. And so by almost any measure, inventories have come back down after having become very bloated last year, which is a major difference between us and other markets. That's why we have a different pattern. And then a little bit of a tailwind also from the energy crisis that's going on this winter with the high cost of gas has led to potentially at least a 500,000 barrel a day incremental demand for heating oil or other liquids to either provide heat or electricity in replacement for gas. So a little bit of tailwind there. And frankly, we have seen the beginnings of recovery. The lowest rates in our segment were in September. We've been grinding our way up through then, and we're very excited about the near term as we go into 2022. Over the near and medium term, what will fuel this market, in addition to just a COVID recovery, is on the crude side, ton miles. That's what the second set of bullets is about. That there's more oil be moving further. So it's not just the demand for oil, it's how far it's moving, and I have a slide on that in a second. And next, with respect to the product tanker business, and as we showed on the first slide of this presentation, we are very much in both the crude oil and refined petroleum product tanker transportation business. So we're diversified. We will participate in both markets, and we will benefit from the medium-term uptick in crude and products from primarily refineries moving from the place of consumption to different hubs in either the Middle East or Asia. That long-term trend, it means more miles of product moving on ships on the ocean. And very medium and long term, we think the supply picture for ships is really good. We know that what causes cycles in shipping is after a good cycle, it can come to an end when the vessels get overbuilt. But that's not happening right now. The yards are filled up for several years, primarily because they've been full with orders from other sectors that have been doing so well. So really good demand and supply picture for tankers as we look into the near and medium term. A couple more points, and next slide to graphically show this. This slide just shows that oil demand and supply, after having obviously taken a huge dip from 100 million barrels a day down to 75 briefly in demand last year, have recovered to the pre-COVID levels. Next slide. And I mentioned inventories. The dark blue line on the left is days of forward cover. And you can see that, obviously they spiked up a lot last year because both inventory was up and then demand was temporarily down. So the forward cover days obviously went way up. But now we've come back down just about to historical lows in terms of inventory levels overall and days of forward cover, which means that as demand for oil continues to steadily grow back to the pre-pandemic levels, the marginal barrel will come on a ship rather than being drawn down from inventory on land or at sea. And the right-hand side shows you that floating storage, which had been very high, has also come down quite a bit. Next slide. I mentioned that a couple of the medium-term factors for crude and product. The first, this is a little bit more on the crude side. I'd say the takeaways from this slide are just this simple. The growth in production of crude is in the West, whether that's North America or South America. You see that on the left-hand side of the page. The growth in consumption for crude is not in the West, it's in the East, it's in China and Asia. So that means that there will be more oil. It's not just the amount of oil that's being consumed, over the coming years, it will be ton miles moved. So that's very positive for our sector. Next slide. And on the refining, on the product side, this is a little more data on the changing pattern of where refineries are built. As I said, the traditional model was to build a refinery as close as possible to the consuming country, whether that's the US, Europe, Australia, whatever. Now it is that refineries in all those places are being closed. There's a net negative growth of refineries in those developed nations, but refineries are being constructed in the Middle East and in Asia. And as a result, the products that come out of those refineries, gasoline, diesel, jet fuel, naphtha, et cetera, will travel further to get to the ultimate consumer. So that's a very positive medium and long-term trend for product tankers. Next slide. A couple of slides on tanker supply just to finish it up. Basically, this is telling you that over that there was a lot of tankers built in the super cycle period of the 2000s. Not surprising, like a lot of other markets, that crazy super growth in demand led to a lot of building. But over the long term, year on year, fleet growth is going down. And then the next slide really sums it up. You can see the effect of that is on the left, the average age of tankers is going up. When you order a lot of tankers like we did in the early 2000s, the average age goes down. As that gets worked off, the average age goes up. And sort of the flip side of that coin is the order book. If you look on the right-hand side, that's probably the most compelling story we can tell about how as the demand side recovers, how the supply side of tanker shipping is really healthy, because the level of the order book, 8.1% for crude and 5.8% for product, is as low as it's been in 20 years. So that really bodes well for a strong recovery continuing once we begin in earnest next year. And just two more slides to finish it up. Next slide. This is both crude and product, and you see on the right what's the order book, 8% and 6%, as I said, in the light bars. And as you can see, just looking to the left in each case, that order book is matched by vessels that are 20 years and older. So even without growth in demand, the vessels on order are just barely sufficient to replace those vessels that are 20 and over. And as we can tell you about our business, frankly, the vessels that are 20 years and older really aren't trading to the major customers that we deal with. They're marginal to begin with. So we really, this is a picture of a very balanced supply picture for tankers. And then finally, the last slide just tells you that the order book, the shipyards are full of orders for ships of other types of tankers. So if you were to order a tanker today or try to order one, you would be looking at 2024 at the very earliest, and not so many slots there. So even if we were to see tanker ordering pick up, it wouldn't be able to affect our market until at least 2024 or 25. So I would wrap it up by saying, hopefully I've given you a bit of an introduction to International Seaways, made our case for being a disciplined capital allocator, investing in ships and companies at the right time, but also consistently returning cash to shareholders, at best in class in terms of technical, commercial, and most importantly ESG. And finally, now is a really good time to be looking at our sector. So as you look at the tanker shipping sector, keep us in mind. We're the number 3 globally and number 1 US based tanker shipping company, and looking forward to a really exciting 2022. And with that, I'll turn it back over to Poe for questions.
If we could just start off by talking a little bit more about, you think a recovery is coming in 2022. Can you talk about which segment, either the crude oil or the refined product segment, will lead the recovery? And maybe just why do you think that? And then also what'll lag it, and the potential reasons why there would be a lag.
Sure. Thanks, Poe. Well, we think the recovery has already started. As I mentioned, the rates for both crude and product tankers probably hit a low in the third quarter and have been working their way up since then. And you know, it's a really interesting question about in any tanker cycle, which segment either the crude or product leads. And I think it depends on the nature of the particular facts around that cycle. And but the key fact is that over the longer term, even fairly short term, like 6 to 9 months, if we look historically, within that kind of period of time, crude and product rates do correlate. So you won't have one racing way ahead and the other lagging for too long. But to answer your question, I really think that product tankers are going to lead the way this time. And I think the reason for that is that while inventories of crude oil and refined products have both declined or worked their way down to historical lows, to where we're at sort of the logistical ideal, where consuming means tankers are necessary for the logistical supply chain. You know, the crude oil inventory is in large part governed by OPEC, and OPEC is being really careful about how they release their inventories. They haven't bowed to pressure. They kept their rate of increase going even with the Omicron, but they are certainly bringing less oil onto the market than the Biden administration or others would like. You know, so I think that maybe it's just a question of politics, but I think that since the product tanker inventory or product inventories are driven by the market more than a political force like OPEC, you're going to see that recover first. And you've already seen a bit of that. The rates in some of the product tankers, even from the LR1, LR2s, the largest product tankers, down to the handies, which have spiked recently, you know, are showing some signs of logistical tightness that leads to higher rates.
Great. So it's, you know, OPEC, it's really sort of watch OPEC for the crude oil side and watch the market for the refined product side?
Yeah, I mean, you for the refined product side, you're going to want to see that the Omicron is not having a huge mobility setback, which is our base case right now. That there will be reactions to it. There's, you know, new face mask requirements, et cetera, but not massive lockdowns required by governments from a health point of view at this point, which is how it looks to us. So we think we're continue on that demand growth that we've seen. And also key factor, Asia, Chinese Olympics. You know, China in particular is keeping a real lid on mobility on the margin until after the Olympics, because they want to be sure to keep COVID at low levels and pollution at low levels. There's a lot of emphasis on that. So I think it'll be really interesting to see what happens to the marginal demand for refined products after February.
And when you look at your fleet is pretty broad. You said, you know, the third largest. It's pretty broad. It has both crude oil and refined product tankers. What is your optimal fleet? Is it the way it is now, or will you continue to see, you know, a fleet renewal program that, you know, potentially acquires or builds versus selling some of the older assets?
Well, in terms of crude versus product type of vessels and size, we like big crude, which we define as VLCC and Suezmax. Those are pretty much interchangeable vessels. You know, it's either 2 million deadweight tons or 1 million. Pretty much take your pick if you're an oil company. So that's one homogenous sector. And then we like the MR segment that we're in. Became a very sizable player in MRs with the acquisition of medium range product tankers, the workhorse of the product tanker industry, the one that's going to benefit most across the board from an overall economic recovery. You know, we have a very substantial position in that segment. And then one niche we have that's important to us is the LR1 long range product, or Panamax crude. It's the same size. It's a segment where we're involved with a proprietary joint venture in South America with a couple of other parties down there, where we really are very close to freight coming out of Latin America going to the U.S. West Coast. So those are our segments. And, you know, in terms of what we're going to do, you know, we were 5 million deadweight tons last year and 9 years and age, and now we're, you know, 9.5 million deadweight tons and less than that in age. So we've certainly accomplished any reasonable goal you'd think in terms of renewal and growth by virtue of the transformational merger this year. So when people say, what are you going to do next? I think you're going to see more of the same, which is gradually pruning the older vessels. It's kind of like a dollar cost averaging on the way out. We were 100 vessels at the peak the day after we merged, but we're moving out. We had a few vessels that were between 15 and 20 that were on the International Seaways fleet. We moved them out to responsible, ESG, Hong Kong Convention recycling because the prices were so high. That made good sense. And then the legacy Diamond S vessels that are 13, 14, 15-year-old are becoming gradually non-core because of their age. So there's a real good opportunity, which we've been taking and will continue to take, to gradually sell some of those and have that capital available for capital allocations, for example, buying back shares. So we mentioned that we're trading well below what we think our net asset value is. So if you're in a position where you can selectively sell older vessels in a rising market, because the values of those vessels are stable and slightly rising as we get into the market recovery, and recycle that cash into returning cash to shareholders as well as bolstering the balance sheet, then that's a really good corporate finance prescription. So we like that a lot.
Okay, and you sort of alluded to it, but we're looking at carbon emission rules, whether it's EEXI or CII coming up, at the start of the year after next in 2023. Can you talk about what you think the impact will be on the overall industry, and then maybe take a look down at how International Seaways is going to respond to those new regulations?
Sure, we need 3 more sessions of equal length to cover all this stuff, but at the very high level, as you point out, that there are EEXI, which is the X is for existing, as opposed to DEDI, which is designed for new buildings, but that rules coming into effect beginning 2023 that will really differentiate vessels. They'll be graded on the amount of emissions that they have historically shown or their design inherently provides, or both. And so what's going to happen is that ships with a lower grade are going to be obviously less desirable to customers who are paying attention to how much carbon and other greenhouse gases are emitted by ships that they contract for, which is basically all the major customers that you would imagine we would be dealing with. So what's going to happen is, for us, is that we will invest in those vessels that are of a certain age, no fault of their own, but being a certain age, they're a little less efficient and emit a little more when they move. We'll invest in those vessels where there'll be payback, and that could be a Mewis duct that goes around the propeller to reduce the drag, or slick paints, or other capex on vessels that will improve their grade and their suitability to customers. If we don't think that that's going to work, then they'll probably be prime candidates for moving out of the fleet, as we talked about before, which we can also selectively do. So we move some out, we invest in the others, and of course we have the most modern vessels. Our 5- and 6-year-old vessels and the new builds that are coming are going to be the highest graded. So we really like where our fleet will look in terms of the grading it gets and the suitability it has under EEXI and CII regime, and we think that some other fleets that are older will be less well able to compete, and therefore we'll probably see more ships leaving the fleet via recycling. So that's going to be good for those of us that, if you pardon the expression, make the grade.
Okay, and maybe more scrapping could be likely as we look out. Is another response that the industry will? Do you think they'll slow down the fleet? Is that one that will be a likely response?
Yeah, yes, in time. We looked at our fleet, and we don't see that any of our vessels will have to slow down in 2023, but probably some other fleets that have older vessels may have to already begin in 2023 slowing down. But certainly as you go out into the middle of the decade, and every year the lid on grading for the EEXI goes down, the cap goes down, that the slowing down is going to become, for a number of vessels, the only way to comply and be available to major customers. So You will see, I don't want to oversell it, Poe, but you will see a little bit in 2023 and a lot as we go deeper into the decade.
So it sort of helps that supply picture that, with a low order book, potentially carbon emission regulations, effective supply might be lower than, you expect in 2024 and beyond, right?
Yeah, it's going to begin in we're going to have a generally demand-based recovery in 2022, continuing into 23 with a low supply of ships coming out of the yards, and particularly in 23 and 24. And as you say, a further reduction likely from enforced slow steaming to lower emissions, and or ships that just, even if they can't go slow enough to make the grade, they'll just head for scrapping or recycling sooner than they might otherwise have done. So that's positive.
Okay. And then you talked about the discount to net asset value, and one potential lever that you can pull is stock buybacks. What are some of the other levers that you might be able to pull? And then also, what are you hearing for investors as far as the biggest concern out there, whether it's industry wide or whether it's specific to International Seaways?
Well, I think that the best way we can reduce the discount to NAV, or look at it another way, increase the rating of the stock or the multiples on the stock share price, is to continue the track record that we built. I mean, in our presentation, we talked about 5 years, and the first 3 were really focused on fleet renewal that was absolutely required. And then since then has been allocation between opportunistic growth like the Diamond S merger and returning cash to shareholders. And so now we can look at a 5-year record of capital allocation and a several-year record of returning cash to shareholders. I think that if we just keep doing that consistently and getting the story out and talking about it, executing, then that's going to pay off. I think realistically, when tankers, as they have been the last 9 months, kind of at a low point of the cycle, it's kind of hard to break out of wherever your valuation is. But I'm confident that when the entire sector moves with rates and moving up in 2022, that our relative value, so there's a lot of money to be made across the board in tankers, but at that point, I think also the relative value in International Seaways will become more apparent, and so there'll be even more money to be made than in owning INSW.
And then you sort of answered the top priority for 2022. It would seem like that would be execution. What are your other top priorities in 2022?
Look, I think it's really focused on the response to both the regulatory regime, as you mentioned, EEXI, and the Carbon Intensity Index, or CII, coming into place in 2023. So that means a lot of preparation in 2022. So reducing the emissions from our vessels and therefore increasing the value of our fleet, that's number one. Second, continuing to stay the course on capital allocation, do more of the same. And third, it's being prepared for the medium and longer term. First, with where the industry is going, first by taking delivery of these dual fuel LNG vessels. So again, looking at how we can further reduce our emissions, but then also a weather eye out on where the world's going. What's going to be the fuel of the future is important, not just in terms of what's propelling our ships, but it's the fuel of the future is going to be the fuel for not just ships, but trucks and cars and planes and heating, et cetera. And whatever that is going to need to be moved by sea. So we also have a view as we beginning in 2022 to look out to where we'll be 5 and 10 years from now. And we want to be a leader in the tanker industry, however liquid energy evolves.
Thank you for joining us for this NobleCon online investor event presentation, brought to you by Channel Check and Noble Capital Markets. Visit our YouTube channel for more video content, including interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and microcap companies listed.